on the third day of BFSI Summit. I'm sure you've enjoyed all the sessions till now, as some of the audience members were sharing with me earlier. We've heard from three biggest financial regulators yesterday, setting the tone for discussions. We've had discussions around insurance, pensions, digital currency, crypto, AI, and whatnot. Today is all about markets. We have a very informed audience, so I'm not going to get into the nitty-gritty and jump right into our first session. Has the Gift City IFSC truly arrived? Let me start by inviting on stage Khushbu Tiwari, Special Correspondent Business Standard, to conduct the session. May I start by inviting our panelists as well, Mr. V. Bala Subramanian, MD and CEO of NSE International Exchange. Please give him a big round of applause, ladies and gentlemen. Our next panelist, Mr. Tushar Sachde, Partner, PwC. Please welcome with a big round of applause, Mr. Sachde. We have next Mr. Dipesh Shah, Executive Director, IFSCA. A very warm welcome to you, Mr. Shah. And, of course, we have Ms. Revati Kasture, CEO, CareEdge Global IFSC.
A very warm welcome and thank you for joining in at an early hour. And we have a very esteemed panel today from very different walks of Gift IFSC that we talk about. And Gift City was our answer to Dubai or Singapore, and it is our ambition to be the kind of financial sectors or the centers that they have become. We want to be like them, but more than them. And we are truly asking this question of how far have we come, how more do we need to go for? And we have Dipesh Shah, and who better than him, because he has been associated since 2008. So he has seen it rising, rather in a bud stage, and now flowering. So how far have we come? And do you think, when can you truly say that we have arrived?
Thank you. Thank you, Khushbu, for this, organizing this very important panel on the Gift City. I'm sure the participants in this room probably are well aware of GIFT by now in terms of what is happening on ground there. And when we say that as it truly arrived, I think let's talk on some numbers as to where we stand so that we can appreciate what is happening in that financial center. I think first, as you said, that in compared to other financial centers, if we really look at London and US, obviously it's a 100-year story. You are talking of a financial center well established. And then you look at some of the other new financial centers, so for example, DIFC in 2004, and then ADGM in 2015, and to some extent even Malaysia tried Labwan in 1989. So there has been the history of financial centers which has been moving, in terms of undertaking international financial services business. And most of them have been riding on India opportunity, because what I used to see was that, when we meet those financial centers representatives, they do a very special session in India to understand our problems. They go back, they correct their regulations to bring more India business into their financial centers. So I think for them, it was just to plug India issues and you have, large business to do. And I think all credit to the government of India to think that, why should we export financial business outside and jobs outside? Why can't we attempt GIFT? But for us, the GIFT is probably a center on the block, but as we have passed 5 years and there are some numbers, let me say that we have crossed now 1,000 registrations in the financial center itself. And this numbers has moved from 129 to 1,000 in just a matter of 3 to 4 years after the financial center authority got established there. We have touched $100 billion of banking asset size now sitting in GIFT, which was probably zero, because most of our lending were all coming from outside India, and we were not lending from India dollars to Indian corporates and to outside. So we have $100 billion of banking asset size sitting now. I think you have Bala sitting here, and he just messaged me in the morning, $103 billion, highest monthly turnover on the stock exchange ever, which means that in even the monthly turnover on the stock exchange is across $100 billion now. And we are also talking of 35 business segments operating in GIFT now, which is not purely a traditional banking, insurance, and capital market. we have moved much beyond that, and we have now alternate investment funds, finance companies operating there, your fintech firms operating there, and even foreign universities operating there. So if you really compare this, and if we compare ourselves with maybe ADGM, because it was 2015, obviously when you start with comparables. And if you really see what is happening in ADGM as we speak, I think we already crossed the banking asset size. We already crossed the number of banks that we have versus what the ADGM today has. And probably we should now eyesight ourselves to DIFC as to how can, quickly we can make ourselves comparable to DIFC, and then probably slowly move towards what Singapore is doing in terms of the international financial services. So I would definitely answer positively that yes, GIFT has arrived. It is now in the interest of everyone to make it more rapid and more faster and make it more comparable to Singapore and other financial centers.
So definitely, we're talking about the milestone on the NSE today, and there's another milestone that it is achieving on the direct listing part. We already obviously know that one company has already been there. How many more are we expecting? And as sir said, obviously there's been a lot of activity on the fund management side. It has doubled nearly in just last 1 year. So last 1 year has been a highly active stage for at least on the fund management side. For you, how do you see how many more companies are we looking forward in the next half year or so, or even for the next fiscal? What is the outlook like for that?
Thanks, Khushbu. And I think Dipesh has set the right context. So I think NSE International Exchange, which is the only one subsidiary of NSE, is the leading market infrastructure institution within GIFT City. We actually have more than 99% plus market share in all the segments which we actually operate in. And typically, coming to derivatives, we are already proven to be very successful. In fact, for many in the audience, they may not know, the GIFT Nifty futures is something which people can wake up in the morning and watch where the Indian markets are. And even we trade almost 21.5 hours. So effectively, even for post-market events, and in the last 1 year, we had many of that, many people still come to use GIFT Nifty as the benchmark. And the beauty is that we are now almost trading on a daily basis, almost 2 to 2.5x of the total futures volume in India. Okay, so that is something which is very less known. This week, we also touched another milestone of almost $22 billion open interest. So open interest is the true liquidity measure as far as the risk management markets are concerned. And there again, our numbers are 4 to 5x of India's open interest on the Nifty. So this is just to get a benchmark. Obviously, over the last few years, we have enabled many Indian companies to raise debt capital. And debt capital has become a serious business. I think now more than cumulatively about $80 billion of medium-term notes programs have been established, and almost close to about $55 to $60 billion of bonds have been raised. And that numbers are going to grow fast because just last month, RBI also liberalized and allowed more companies from India to start tapping the external commercial borrowing framework, and that I think should definitely augur well for us. Now coming to your pertinent question on listings. This is something which has been there since day one. So there were two ways we could actually approach investments market in the GIFT City. One was, I was part of the core team way back in 1993 in NSE. And NSE was a new exchange with an 100-year-old institution. And what we did there was we quickly created something called a permitted to trade category. And we got the top stocks which are listed to actually be allowed for permitted to trade. So we had a similar proposal which we had given way back in 2019 to SEBI, because at the time SEBI was the regulator. IFSCA got created in 2020. And we still are pursuing it. Basically, the idea was that there are many Indian companies which go to New York, NASDAQ, or to London, Luxembourg, and issue depository receipts. So one of the ideas was, can't we look at the top 250, 300 names where foreigners are investing, if we can get a depository receipt market going in the international side in GIFT City. That would have immediately created an investment ecosystem market, and a lot of people would have started using it as a thing. So today, we have all the Indian derivative products available with us, but we don't have the Indian equity products available with us. So what we are now looking at is actually creating fresh IPO issuances. I think after IFSCA got created, the listing regulations were published. And I think last year they actually smoothened out the regulation. And now we are seeing one company called XCD, which is an Indian company, which has actually filed an IPO with us. It's a small one. It's about, they're going to raise about $15 million. But apart from that, we have also been doing roadshows since last 1 year in terms of how we can actually get many companies to come and do IPO. I can't give you specific names, but at least 3 or 4 companies, even companies from Silicon Valley, are in touch with us. They are actually looking at filing IPOs, and these are going to be a significant one because we are looking at the sweet spot where people can raise something between $50 to $200 million. Because in US markets, typically issues below $1 billion cannot go and get an IPO. Thirdly, we are also seeing new trends where many companies now are even approaching us for a direct listing because they think that the corporate governance norms, the listing norms, the disclosure norms are all good, and they want to build a credible reputation. And at some stage, they will basically go and do a follow-on issuance where probably both resident Indians, non-resident Indians, as well as international players can come and co-invest in that.
Yeah, thank you for giving that detail on how many Silicon Valley companies are planning to come back to on our own international exchanges. There are a few important questions here, but we'll take them after we have had a round of discussions, both on the expiry date that you have mentioned and on the participation from the different class of investors. I'll come back to Refti here. You are one of the participants here, which has a very different sort of business, and you are one of the 2 earliest companies or the credit rating agencies to set up in GIFT City. What brought you here? What opportunities do you see?
Okay, thank you so much for that question, Khushbu. Whenever a financial ecosystem has to develop, you definitely need firstly the regulator. Then you need exchanges, depositories, the issuers. You also need trustees. You also need a rating agency because that's really completes the financial ecosystem, and that's where we kind of plug in. So we are very much a part of the buoyant financial ecosystem which is developing in GIFT. ISCA came out with a credit rating agency master circular in 2024, and we were the first to apply to get a license. And we have a regulator who is market friendly and looking at opportunities to create business in the market. And we immediately got our registration last year in July 2024, and we started operations in October 2024 by launching ratings on 39 countries. Now, the reason why you need a rating agency from a country like India is that, for very many years, we have seen only the US-based rating agencies dominating the world rating market. And when we got to study the methodologies that they are using for rating different countries, we found that there is so much value to be added to get the methodologies current. Because, if you look at the world GDP today, 45% is contributed by emerging economies. And when that's such a significant portion of the world GDP, then there is a very important reason why emerging market nuances should be inbuilt in global rating methodologies, which we thought was not happening. So that's the reason that we really started doing this exercise much before we applied, about last 2 to 3 years ago. We put out our methodologies for public consultation. We interacted with a lot of multilateral institutions to see how we can hone those criteria. And we are so proud to say that when we launched our business in October, we launched it with 39 country ratings. We rated India BBB+. And in the last 1 year, we have seen in 17 out of those 39 countries, the global rating agencies moving in the direction of our rating, which is a very significant validation of the work and the necessity for a rating agency per se.
Do you think you can outgrow your domestic counterpart of your own group firm?
The opportunity is huge, Khushbu. So here we are not looking at only just like NSE, IX and IFSCA is not looking at only attracting Indian companies to come and list on the exchanges. Similarly, we are not only looking at Indian companies to do the rating. So right now, we've done about $4 billion worth of issuances, which we have rated in that company. And we've done about 17 company ratings. These largely are Indian companies who have gone to the gift market to borrow or would go to the gift market to borrow. But as we speak, along with the other players in the ecosystem, we are also doing a significant amount of outreach to countries, firstly the neighboring countries in Asia, countries in Africa, where we are proposing a very credible alternative to a DIFC or a SGX. And SGX has, about 2.73 trillion worth of bonds listed. GIFT has what, 70 billion, $65 billion worth of bond listed. So you can see the size of the opportunity.
Well, all the best for that achievements, and we see how you grow the same trajectory and the momentum. I'll come to Tushar, and there's one perception, obviously, because the taxation regulations and the relaxations for the GIFT City had come very early, and we saw there's a perception that it's for tax saving. Do you believe in that perception for the HNIs or something, or how do we break apart from that perception, or how good is to stick by that perception?
So, as you know, that GIFT City got set up, and as Dipesh sir also rightly pointed out, it's basically that you saw a lot. India is an importer of capital, right? So there's a lot of capital which comes from offshore market, whether it's US, whether it is Europe, whether Asia, and we had to. The idea of GIFT City was effectively to onshore the offshore financial services, right? Because a lot of capital comes from third country and gets into these financial centers like, say, Singapore or Mauritius. Now, of course, it's no more, but Mauritius at that time was quite popular, right, from a jurisdiction perspective. And also Luxembourg Island. These are the jurisdictions, right, which are known for rendering financial services, whether it's about, say, funds investing into the country, or whether you're talking about banks lending into the Indian ecosystems, and many others, right? So idea was to create the financial center within India, right? And which is what the GIFT City is. And for any new financial service center, you have to create a pull factor, right? Because you can't expect a financial service center to be successful without there being a pull factor. But I don't think so. While there is a overarching 10-year tax holiday, which acts as a pull factor and is a tax incentive, but in general, I don't think so the government has gone crazy about how the tax incentives are given. Now, let me give you an example. While, say, look at a fund industry, right? So there is specific exemptions for public market funds which are raising money from non-resident investing into the country, where other capital gain other than shares are exempt, or interest and dividends are taxed at 10%. Now, you might say that, okay, it's a tax incentive. But when you compare in the international market, these are the exemptions which are available under the tax treaties that India has signed with many countries. Like you look at India-Singapore treaty, or same as Mauritius treaty or a Lux or Ireland treaty, it gives exemptions for capital gain other than shares. It gives lower withholding tax on interest and dividend. So if you don't give the similar treatment in IFSC, what is the reason for these funds to come and set up here? So it is not that it is all about taxes. It's more about creating ecosystem within the country, creating more jobs within GIFT City. And to give you an example on the fund. So what is selling from a fund perspective is that in treaty and all, you have a lot of uncertainties. You have what we call as general anti-avoidance rule, where the treaty entitlement good questions, there's substance requirements. So those issues go away because the GIFT structures give you significant certainty, and which is why we see almost 280 funds, 300 funds. Now, of course, he will have the latest number. I have the 2 months old number.
I'm just waiting for their September bulletin because every time.
That's good.
So
Even
far
I pulled it
reviewed.
from 277 as I saw in the last bulletin, but he says more than 300. So that's on the fund. But if you look at other regulations, like you look at GCC regulations, right? So we have Bank of America, which is the first, I think, the large GCC which is set up with 3,000 people. While they get the tax incentive, but the fact that it's created so much of employment within India, it has created ecosystem around employment where the government can benefit of. So it's not all about taxes. The tax benefits are more specific in terms of the areas in which they needs to be given. And that Indian government has used taxes as an incentive for a long time. Like, if you want to set up a factory in Northeast, you get a tax incentive.
So is there a case to extend this 10-year period? Because many fund houses or other entities say that still, if you are planning or if you are setting up somewhere outside their own jurisdiction, 10-year is still a short term.
I would tend to agree, and in fact, I'll tell you why. Because, okay, on the funds, I must say, the exemptions which are given on the fund is permanent. So it's not because when you set up a fund, you're dealing with third-party money, you have to give certainty, right? So those exemptions are permanent. So those are not subject to 10-year limit, but general exemption is. And of course, I think there is a case for extending that because people are looking at, because Gift City, the professor is working in 2008 and he was in GIFT when we started working with it before IFSCA was set up to kind of see how the regulation can be framed and all. I think the time now is the time. Ball has started rolling, right? So now you will see, of course, the 10-year tax holiday applies from the time the entity sets up. So it's not from whatever, it's not like a certain date that from this date to this date. It's from the time you set up your business, you have 10 out of 15 years that you can choose. But still, I think giving us longer term certainty to businesses in terms of tax holiday would be important, and there is a case for extending that to whatever, at least 15, 20 years, at least that gives a long horizon to the businesses.
So we'll come back on the suggestions part, but one question for Dipesh. You are a unified regulator, but you're still dependent very much on the domestic regulators for many policy decisions, be it allowing FPOs, be it allowing brokers in GIFT IFSC, be it allowing the cross-border transactions. On that basis, you are dependent on RBI, on family investment, the FIFs that was to be set up, also that you need certain permissions or consultations with the RBI, and for capital market you need for the SEBI. So how do you see your independence, or how do you see your policy making being impacted or by all these other dependencies on other regulators?
I think what you said is was partially true when the IFFC was not created, because that was the time when the domestic regulators were creating the carve-outs for the IFFC zone also. But post 2020, when the Parliament passed the IFFC Act and the IFFC authority has been now placed there, the powers of all these 4 regulators are with IFSCA for the regulation making. So let me clarify, for regulation making, there is no dependency on anyone. It is the IFSCA which creates the regulation, goes for public consultation, and the similar process what other regulators follow, we also follow. So there is no issue there. I think what you are trying to refer to is that an Indian entity wants to come into GIFT to operate. Obviously, if they are regulated by the domestic regulator, you need an NOC from the domestic regulator, and then you can enter the zone. If a foreign company comes into GIFT, he directly takes the IFSCA license and gets operational. Like, for example, a bank which is not licensed in India, but wants to come into GIFT. And now we have such cases like the Taiwanese bank, which is not in India, but they are setting up in GIFT. And so there's no dependency for those matters. But what you are probably trying to convey is that are our policies needs a dependency on the domestic. So for example, 100% NRI participation. Now, this is where you should give credit to the domestic regulators, that they thought a carve out for GIFT. If you come from Singapore, you can't have a 100% NRI fund. You come to GIFT, you can have a 100% NRI fund. Now, this type of carve outs, which will give a preferential treatment to your own financial center, will probably help us to move fast, because you are competing with very established financial center outside. And for so many years, they have the credibility of tax, they have the credibility of regulations, everything. So if you give this type of preferential treatment to your own center, I think our speed of getting there will fasten.
So I'd like to add to this, what he's saying is that, even if you look at the credit rating regulations which IFSCA has come up with, they are not borrowed from the local domestic regulators, but they are actually aligned more with the international regulations for credit rating agencies. They align with the ISO code of conduct. So, there are certain products which are not allowed in the domestic market, like private credit ratings, which are allowed internationally and are allowed at GIFT. So some of these things which, in terms of regulations, I would second that they're not looking at the domestic regulator. They are actually looking at international regulators.
Just to add further, so I was on the asset management committee which recommended the regulation. And if you look at the alternatives regulations in GIFT, which is applicable, is completely different. It regulates the fund manager and not the fund, while the domestic regulator regulates the fund and not the fund manager. And she rightly pointed out that the regulations are very forward-looking. The competition is not India. Competition is the international financial centers. The other thing I want to, and I think it's a misnomer to say that there is a dependency, because there is zero dependency. So as Dipesh sir pointed out, there is a foreign bank coming in or a foreign broker coming directly. They don't need to worry about it. They need to look at the IFSCA regulation, and they will give the license based on whether they meet the criteria or not. The dependency comes when you are dealing with India, which will come irrespective of which country you are set up, whether you set up in IFSC or you are set up in Singapore. If you are investing in India, in a capital market, you have to meet the FPI regulation. In fact, there are advantages of IFSC, as Dipesh sir pointed out, that you can have 100% NII fund, which can't do in Singapore. You can do it in IFSCA, but that is related to FPI regulation. Or even if the Indian financial service player is going out, then of course you have to meet the regulations of the domestic market. The one other important on the, you talk about FIF, right? Now, if you set up an outbound fund, and that is one of the big theme currently going on in IFSC right now. There are more than 20 outbound funds. And there is LRS money. There is a broker which has got about 20 million LRS accounts already opened in GIFT in IFSC. There you can invest in a fund which is set up in IFSC up to 20% of net worth of any entity, which you can't do in Singapore. So there are actually advantages. There is no dependency.
So rightly pointed out, so because now the GIFT City is opening for retail mutual funds also, and we have seen certain entities setting up the retail category for mutual funds, and also on the FIF side, we still hope some more participation will obviously come. But aligning with the global part, I think one thing that NSE International Exchange has aligned is the zero-day expiry. But which is very different from how we approach the derivative segment in the domestic side. Any views on that? Because on the domestic side, it is seen as we are trying to limit the number of expiries. On the IFSC, as globally aligned, it is more of zero-day expiry, that every day you have an expiry.
So I think this buttresses exactly with the topic you discussed. So we are aligning all our regulations with the global jurisdictions. Zero-date options have been in existence for the last 10 years. And in fact, it is a pretty popular product in US. And in fact, many other jurisdictions have also started adopting it. I think GIFT IFSC also is one of the early adopters, let me put it that way. So I think the regulatory framework which IFSCA has adopted is forward-looking, progressive, and in tune with what is the global benchmarks. And that is the reason why it has been permitted. It's a very recent kind of a thing. Secondly, many people have concern because they think it again from India prism. So one is on derivatives, no resident Indians are allowed to participate. So this policy doesn't impact anybody in India or the India's regulatory stance as far as derivatives regulations are concerned. So we are primarily talking about dealing with international participants, dealing with non-residents, and also prop shops which are actually becoming offshore from India, which come into GIFT City. So these are the set of players who are going to look at it. And thirdly, when I started, I said the derivatives market is double the size in terms of the volume or 5x in terms of the open interest. This shows that derivatives are very popularly used by international players on any exposure in India. Sometimes they may not want to do an investment in India, but they can actually take a synthetic bet using derivatives, and that is the reason why the offshore markets have a very large derivatives presence. If you look at Singapore, for example, we keep on hearing that they are a financial center which has been established over 50 years now. Their derivatives market size is extremely large. Their cash market size is very small. Okay, so why I'm saying is that GIFT IFSC also will in some sense provide a large play for people to come and use synthetic products, and that is where it comes.
So one more, sorry I'm cutting in, one more space where resident Indians are not allowed is direct listing, participating in the listed entities that will list on the international exchange. So do you think that will lead to any kind of liquidity concern, because it's a still growing market? People would trust more from a jurisdiction like India, where you are more well versed with, like the investors would be well versed with or more confident on IFSC at this stage. Do you think that will concern the liquidity, or do we need any address on that?
So there are two things. India today has already become a very hot IPO market. So effectively now a lot of Indians are coming to the market and directly investing. Now this opportunity is now being slowly realized by international companies. If you look at in the last few years, all the big major companies of international companies which have come and started doing some work in India, they all started creating IPOs in India, and somewhere the Indian companies are much larger than the global parent. So this is exactly the trend which actually GIFT also wants to accentuate. So there are many foreign companies which may want to look at GIFT IFSC where they can raise both money from Indian investors because their LRS is permitted, because Indians can invest in foreign companies using the LRS route. And the international pooling of capital can also happen, and it can happen in our own financial center. So that is eventually the big aspiration. Obviously, over the next 10, 15 years, as India becomes more affluent and we start rising towards becoming a middle income country, and that is what the Prime Minister's vision is of basically Viksit Bharat by 2047. I'm sure more and more capital will be provided by India for international opportunities. And that is the reason why I mentioned why Silicon Valley companies in AI and other fields are now looking at GIFT City as a place where they could list, because they think they can actually raise capital from Indian investors. That is definitely there. But from a segregation perspective, Indian companies which are coming to raise foreign capital in GIFT City, their Indian investors cannot invest. But foreign cap companies which are coming to GIFT City, they are open to foreign investors as well as Indian investors.
So, Revati, coming to you now, we'll move forward to a little of what kind of challenges that you have seen in the last 1 year or over 1 year that you have been there, and any solutions that you think of for the same thing. And would you also want more competition for you to come to GIFT City now that you have been the pioneer there?
Okay, so very early days actually. So early days always will bring together with it a set of challenges, a set of teething troubles. It's more on visibility and outreach. So I think that's where most of our efforts and most of the work is. Firstly, visibility and outreach for GIFT as IFC, as a center for people to look at and come. Secondly, Carriage Global as a global rating agency. To bring acceptability in the minds of investors, in the minds of lenders, so that they can rely on our ratings. Which is why I said, in the first year itself, we've got great success. In fact, we rated India BBB+, and after that, there are 3 rating agencies who have upgraded India. So it's just a matter of 1 year that you have 3 rating agencies just following us, even for our home country. And with no home country bias. Mind you, a lot of rating agencies do have home country bias. So we want to establish a very credible institution from out of India where, investors can place trust. And that is really the work and the challenge, both that we are right now addressing.
Thank you. So we are running a little short of time. We'll come back for some audience questions. You can think of your questions. But in a moment, we have one very pertinent question to both Mr. Tushar and Dipesh. Every year, we look forward to the union budget because every year there's a gift for the GIFT City. So what are your suggestions this time, or what are your hopes for both of you quickly on from the union budget for GIFT City?
I think gift are best enjoyed when they are surprise. So let's keep it surprise then.
I can at least ask industry's expectation. You as a regulator can't talk about it. But I think couple of things, I think, which industry has represented for a long time to the government and to IPSCA, which are pending. I think one is, of course, the extension of tax holiday. I think there is a case for extension. The second important aspect is the whole outbound fund. So if you look at, there is a specific tax regime when it comes to inbound funds. So whether it is public market, it is private funds, there is a specific tax regime. You know exactly how you will get taxed. But when it comes to outbound fund, for private there is not a problem because you will still get a pass-through, so you're fine. But when it comes to public market, which is where I think the main interest, if you look at the 20 odd funds which are set up in IFSC on outbound, are all, most of it are public funds. There's no specific tax regime. So it faces with the same issues that you have if you're aware about the whole category 3 issues in the domestic market. It faces the same issue. There's no clarity how the taxation works. And many of these structures are set up as in form of a trust. So then you rely on a trust taxation regime which is set up while the Indian income tax, now of course we're changing it, but it's just a rewriting of the existing law. It's an act like the trust law was set up in 2064, meant for private trust, not meant for something like AIF ever, right? So we need that as one of the important aspects. Of course, I understand there could be concerns around the fact that there's an outbound flow of capital, But this can happen in any other country. So same principle that why would you allow other financial center to develop those products which are available to resident? And as people now, there's a lot of liquidity, right, with the educated Indians, and people want to look at diversification, which is why you saw one of the broker who has set up a global access has now 20 million LRS accounts in a very short period of time. So this is an example where people are looking at these products, and so that's one important ask, that have a specific tax regime for outbound fund. The second ask is a safe harbor regime. So there is a concept of safe harbor. Under the domestic, there is an Income Tax Act Section 9A, which is already there, which basically says that if you are an offshore fund, and if your fund manager is based in India, then it raises several tax issues. So the safe harbor basically gives a kind of a safe harbor to the fund, saying even if you have a fund manager sitting here and managing offshore funds, we will not raise a tax issue for the fund. We'll treat the fund as non-resident. It can be entitled to treaty, which is wherever it is set up. So in GIFT, there has been a lot of ask because there are many global fund managers. They want the India team, because India is like a, you would have heard all about the GCC growth and all that, right? And there's a lot of outsourcing opportunity. And it's more of a KPO opportunity in fund management space. So we have brilliance of mind in fund management. And there are global fund managers who want to kind of ask their domestic fund managers to manage offshore funds, which are not investing in India, even investing in globe. So it's nothing to do with the India investment. They're saying, okay, they will manage a public market fund which is investing in Japan and other countries, right? So that we should permit in GIFts particularly. So that's a second big ask.
Yeah. You want to answer?
So Khushbu, just one last thing which I wanted to mention because I missed it out. So recently, NSE International Exchange has set up a wholly owned subsidiary called the NSE International Exchange Global Access. So this is a very new initiative. This again was enabled by IFSCA recently, wherein they introduced a new license called the Global Access Provider. So this is a very safe, regulated manner under IFSCA's regulatory framework, where resident Indians can now start safely investing in international markets. And clearly, like what Indian exchanges, I think 15 years back, when SEBI actually allowed exchanges to become a platform to actually pool mutual fund investment money. Similarly, we are now creating something similar for outbound investment. And I think this should start going live probably next year, early January. And I think that will be a good opportunity, especially for investors who are looking to diversify their holdings.
As far as I know, the exchanges have already started their discussions with the different market intermediaries to enable the global access platform for exchange-traded funds or any other such, even international stocks and everything that you can access via the GIFT City. And there's also been a regulatory nudge for stockbrokers to facilitate the same. So that will be a very great opportunity. So now we'll open up for one question. So, yeah, gentlemen there. Please keep it short.
Yeah, morning. My name is Nimish. I have a question for Mr. Dipesh. There was a regulation in place for tokenization of real-world assets. And has the conflict of stable coins versus CBDC come to your doorstep? That is the first part of the question. The second related question to Mr. Balasubramaniam is, under the global access, is there any plan for encouraging blockchain-based real-world asset buy and sell?
I think in a financial center, as you rightly pointed out, the points related to tokenization and others keeps coming, because that's what globally this is been debated, and many regulators have come out with the regulation. So for us at the IFFCA, what we thought appropriate was to put up a consultation paper on the real world assets for tokenization, which includes real estates and others, and then look at how can we go step by step, because we are a new regulator. We are just 5 years old in terms of the regulator in that zone. So we just don't want to leapfrog so fast into some of the grappling issues globally, but go step by steps, and probably the real world assets were the logical first step for us to get started, get more experience, and then look at more broader other areas. So that's where we are right now.
Just to add to that, yes, tokenization is a new trend which is here to stay. And I think IFSCA has already created a committee and a public consultation framework. So as you rightly said, the use case could start with real estate. I think there are already some startups or some regulatory sandboxes which are being authorized by IFSCA, and we are closely watching those developments. And to answer you honestly, exchange is nothing but a public token. Okay. So effectively what we are trading is public tokens. What you trade in a stock is also ISIN number, which is also a token in some sense. So there are central trusted systems versus blockchain. So it's only about the technology per se. We should not get confused about that. Clearly, if there is a demand, as an exchange will definitely step to, because we want to be technology leaders, we'll definitely facilitate that. But whatever we are going to do, we'll do it making sure that it is totally blessed by the regulatory framework and the laws of the land. Unless and until there is complete clarity on that, exchange will not go ahead and provide these products.
So just one last question if you have time. Sir, in front.
Yeah, thank you. At the outset, IFSC has been one of the most pragmatic, regulators, and the alacrity in which IFSC works actually is very commendable. Questions. One is that on the digital onboarding of investors, both individual as well as non-individual, where do we stand? That's one. And the second one is that on, I'll ask for the first question.
It's a very important question, I think, in terms of a financial center, because our business is more going to be with the non-residents. The entities in GIFT will be dealing more with the non-residents, and that's why this video KYC and the onboarding comes up. We are at the stage, and probably in a few days or maybe a week time, you will see a notification coming out on the easing the CKYC, the video KYC processes within the IFFC zone, and that's where the market requirements have been coming to us. We also had issued a consultation, and now we are on a final stage of issuing the guidelines for video KYC. And this is just to, as you rightly pointed out, how do we ease the onboarding process within the IFFC zone. But it's going to be a continuous journey, because it's not that one set of video KYC will fit everyone. You may start with the NRIs, then you have to go to foreign individuals, so other challenges comes up. So all those we are right now debating and trying to come up with the solutions which is more comfortable with the Department of Revenue and the Government of India on those lines.
So I have an addition to that. Will that be only for modifications and re-KYC, or a fresh KYC will be possible through video?
See, our KYC mechanism is already in place. Today, so many clients have been onboarded, like 10,000 accounts have been opened by the NRIs for deposits itself. So mechanism is in place. The point is that it needs, currently in India, the IP address cannot be outside.
And geotagging and all is also.
Yes, so that's where we are trying to address that from an IFFC perspective.
Yeah, thank you so much.
Just one,
I think we
on
can
the
take that
passporting
offline
part.
if possible.
Sure.
So I think they'll be here for some interaction, so you can take them, and we'll have to give up space for the next panel. But it has been a very interesting discussions, and thank you all for joining. And you said you are 5-year-old, but yeah, 5-year young regulator, but a lot has already been done, and we wish the best for all of you. Thank you so much.
Khushbu, I have one suggestion for you. Next year, you should have the Business Standard Summit on BFSI in GIFT City.
Very well, sir.
And then you can say the gift has truly arrived now.
Great suggestion, sir. I think if business standards presence there makes it arriving, so why not? We'll probably look at it. Thank you so much.
Thank you, Khushbu, and thank you to all the panelists for such a lovely discussion. May I please have the mementos for all our panelists here? And after that, of course, I'll request the panelists to gather for a group photograph. So, the GIFT City may have faced some teething troubles, but it's going strong. There is a lot of ground to cover still. As Ms. Kasture pointed out, there is a need to improve the visibility and outreach for GIFT City, but I think they are off to a great start. And of course, the budget demands. We are 3 months away from the budget, so I'm sure we will see some announcements for GIFT City as we do in budget after budget, and of course some surprises too. For all the audience members here, if you want to attend the session upstairs, in Hall 1. There's a fireside chat with Rhythm Desai, MD Morgan Stanley India, that is underway right now. You can join, and we'll see you for the next session in this very hall at 3:40, and that's the session on India's broking industry. Have a good day. May I please once again request all the backbenchers over there, please come forward and take seats. You'll have a much better view and a much better audio. And of course, we want you to engage much more. Hope everybody had a good lunch and you had enjoyed the sessions that were there in the Hall 1 or the Firesides chats. This is the last panel discussion, not just for the day, but for our 3-day summit, which will come to a close after the last Fireside chat, which will happen in Hall 1 after this. I'll tell you more about it at the end. But we have our panelists here with us for our next segment, the panel discussion on the broking industry of India, which has seen a phenomenal run after COVID pandemic, but there has been a pause to the growth, and we will delve deeper into this issue, whether this pause is temporary and just a phase or something else. The subject of our panel discussion is India's broking industry, growth pause before the next leap. Well, we will get all the answers. First, let me invite on stage my colleague, Markets Editor, Business Standard, Puneet Wadhwa. Puneet would be moderating this discussion. And let me start by inviting our panelists as well. Please give a big round of applause to Mr. Pranav Haridasan, MD and CEO of Axis Securities. A very warm welcome to you, Mr. Haridasan. Mr. Ajay Menon, MD and CEO, Retail Wealth, Motilal Oswal. Welcome, Mr. Menon. Mr. Shripal Shah, MD and CEO, Kotak Securities. A very warm welcome to you too, Mr. Shah. And Ms. Amisha Vora, Chairperson and Managing Director, PL Capital Group. A very warm welcome to you, ma'am. One of our panelists, Mr. Pranav Haridasan, has to leave a bit early. So we would like to do the group photograph with all the panelists before we start the discussion. Can you please do? You can stay. All right. The charm of BFSI has worked. We usually do clap when the group photograph is happening. Come on. All right. Over to you, Puneet.
Good afternoon, everyone. It's a very opportune moment and an appropriate time to be having this discussion while the investment or the stock market interests everybody. We have the best, one of the best, broking platforms that enable those trades to happen. Let me begin by asking you, Shripal, how have the fortunes of the broking industry shaped over the past 1 year? We have seen a slower pace of demat account openings, lower trading volumes as compared to the last 1 or 2 years, especially in the F&O segment, and nervous secondary markets. So how has that shaped up for the Indian broking industry?
Yeah, Puneet, thanks. You're right. I think broking industry in a way has taken a pause in last 1 year after the last year, first 2 quarters, stupendous growth on derivative and cash segment. And I think it was much needed pause also, because to get into the next phase, you need to reboot. And that's what is happening. A lot of regulatory changes have come in derivative market. And you have seen some of the regulatory changes which has impacted brokers' earning also. Demat account opening, your active accounts, the monthly trading users, everything we have seen, there is a drop vis-a-vis first 2 quarters of last year to this quarter is around 30% in terms of derivative orders. So yes, it is a pause, but in my view, this pause is going to get into the reboot mode, and how do we ensure that we get into the next phase? Particularly if you look at it, Puneet, the last SEBI study, which is saying, 63% of the Indian households are aware about capital market, but only 9.5% are participating in capital market. So I think the first job of awareness is already done by all the players in the industry. Now this balance 52% is yet to enter into the capital market, and that is a big opportunity, and I'm sure that this consolidation phase is going to prepare us for that leverage.
So how does one increase this penetration, Pranav?
Yeah, I mean, I have a. Firstly, thanks for having me. I think it's a journey, right? Because if you really compare, I mean, I think US is probably 55-60%. China is still in the close to the 20%, right? 17-18%. So it really depends on when the per capita GDP moves. You would think that the penetration starts to move, right? But I'm glad that the non-institutional parts of speculative activities in India are getting tightened increasingly, as we saw with some of the other areas of online gaming and so on. So I feel like markets are perhaps the most structured, most informed, a place where you can actually drive education and help people to make genuinely a skill-based decision, right? So, I mean, I agree with Shripal completely that there is absolutely the room to grow, but it's going to happen in a secular, steady basis. It's not going to go from 9 to 15 or 16 as the spurt that you saw during COVID. So I think that was one time. Now it's going to be really secular. And also what is interesting for a lot of us, what we've seen over the last 2-3 years is that the importance, we're all moving towards value of the transaction to just account opening. And, like it's true that the DPAMC charges being taken away, some of the fee lines have made us rethink, who are the right set of customers that you can target a certain product to. And I think that's leading to differentiating between someone who comes in with an SIP or with a small basket at the time of account opening to somebody who can actually trade mid-cap stocks to who should trade F&O, right? And I think, and with the technology that exists today, your ability to differentiate using that data has become so much better.
So I also wanted to understand how much typically a brokerage spend on things like client acquisition, cybersecurity, and what has been the trend in the past 1-2 years, and where are we headed? Amisha, if you could throw light on this.
So compliance, I think, has been increasing by the day, from cybersecurity to all the different modes. Compliance costs have really, really gone up. And beyond the compliance, as also from cybersecurity, the DR site, and in account opening also, we use technology. I think this is coming back to your basic question, where do we stand as an industry? So I would like to say my 2 bits like this, that most of us equity market players are trained to look at long term. And what has happened in long term, just to give a few examples, is the cash market volume was just about 22,000 crores in 2010. Average daily cash market turnover. We are at 1,20,000 crores. So the moment you see a decade or a period, you realize that there is a huge growth. The most important next point is that every new client which comes now, 52% of them are below 30, which means that every time they grow in their career, their stature, their wealth, the growth, either for direct equity or for mutual fund, is going to be there, and it's a very long-term curve which has happened. And lastly, with the penetration that we talk about, then now there are 20 crore account which are open, 10 crore unique account which are open, 4.5 crore active NSE account. What is daily active client? I am shocked if my number is right, but I read it on NSE, it is 1,20,000. So daily active clients are a very small number. Active client is one which is active for any time during 12 months. So, as the advisory, as the knowledge, as the AI-driven advisory becomes very tailor-made to the portfolio, I think, like the way mutual fund industry has grown, even broking has a lot of leg.
So, Ajay, how has this investor psyche developed over the past, let's say, 3, 5, 7 years? We have seen, active demat accounts, rather demat accounts being opened. How hard is it to convince people that investing is for long term? As Amisha said, the demographic, the age profile is around 30 now, or probably lower. So those people would take to markets as if it is online gaming. But it has to be, a little more disciplined. There has to be some method to the madness. Are these guys listening to your advice, and how difficult it is to, convey your point across?
Thanks, Puneet, to having me here. Really happy to be a part of this.
Thanks. Yeah. Thanks, Puneet. Thanks for having me here in this panel, esteemed panel actually. So coming to your point, I think the overall market we know has grown in the last post-COVID, which has been the best time for the broking industry per se. The good mix of people sitting at home and the digital growth, the best benefit was to this industry. The way the investors came in and they had a lot of free time. So actually, the biggest problem for this industry earlier was to get new clients into the market. With the change in the digital journey, the way the whole capital market came up in increasing the overall client penetration, that helped in the new client acquisition and the clients coming into this market in a much bigger pace. So what was around 2.5, 3 crores came to around 20 crores in the last 5 years. So the client has come in. Now the point is that what should they be doing, right? There is where the mix of people coming and trading and then looking at F&O and the short-term intraday to the long-term investors. That is where the whole mix changes. So to that extent, the digital journey helped people to come in. Discount broking to that extent helped people to come and trade much more heavily. So I would think that that is the good side of the whole thing, that it helped the people to come into the industry where people were not coming in here already. And they were mainly into FDs and the routine investments where you could not even beat inflation or real estate for that matter. So we have got the people in. Now the time is that they have seen the other side of the story, that people feel that they can come here and make quick money. And there is a daily expiry which was there earlier, and now
element of instant gratification.
Yeah, So, and for the young people, instant gratification makes a lot of difference. But when it comes to sustainable long-term growth, the journey has to be different, and that is where we like to position ourselves from an advisory capability, from a research capability, to see to it that people are at least advised the right things. Give them the right kind of products, right kind of picture from cash market to F&O market. Try to ensure right kind of diversification so that they are here from a longer term perspective. So I would say that people come, people trade, they learn it the hard way. Maybe there is a tuition fee to come into the market. And then they understand that this is not for a short term, this is from a longer term perspective. Build your portfolios. And you can see a long-term return if you are doing it consistently with good advice and doing research before you trade and before you invest, rather than post the whole thing. And that is where this whole industry is now going to pivot. What you said as a pause, I think now people have come to know that everything is not going to be intraday and overnight. You will have to think from a longer-term perspective, look at it from a fundamental perspective, and build your portfolios, which will give you sustainable long-term growth. And if you see at the growth of the Indian economy and the way the overall returns are, it's a no-brainer that if you're in the market, you will make money. Question is to be in the market, rather than trying to punt money and try to multiply it in a year to double it. That's not going to sustain. If you're going to make anything between 15 to 20% a year, you're doubling your money in 5 years. Where can you do that? So it's more about the compounding journey which people should be understanding, and that is where the whole market should evolve, and that is where the whole education, the whole thought process is happening, so that people are here from a longer term perspective. And this 20 crore number or 3 crore annual investment, what we talk about, should consistently grow, because we are still a young country and this is going to consistently grow from here on, and there's no doubt on that.
Sripal, how has the industry coped up with discount broking platforms? We had brick and mortar outfits, we had discount broking, practically no fee for trades. Then these guys realized that, okay, some bit of fee is required. How has the traditional brick and mortar outfit coped up to the challenge from the discount broking side?
Yeah, a very nice question. You're right, discount brokers have disrupted the market. But one thing I would say that digital is not someone's monopoly. Even if you are a full service brokerage, you can also offer equally good digital platforms, right? So yes, they started with discount brokerages, but one thing they did ahead of full service brokerage was they adopted digital faster than what full service brokerage is adopted. So yes, they offered discounts and they created and adopted digital platform first. So that has helped them grow faster. But I would say that they have actually helped create the ecosystem more digital than any other industry. If you look at today, broking industry is one of the fastest adopter of technology in any BFSI sector. You name any technology, I think broking industry is the one which has adopted it fast. So now the approach by digital brokers versus the full service brokerage or bank brokerages like us, the approaches are different. Like when digital brokerage started, they said, okay, fine, we will not charge anything on the cash market, but we'll start charging on trading volumes, which is derivative or intraday. And of course, the derivative and intraday volume grew for their benefit, and they made huge money. Today, if you look at it, even today, after the derivative tightening by regulators, their 75 to 80% brokerage income comes out of derivative. Whereas as a full service brokerages, we have continued to have a balanced approach. How do we ensure that we don't rely just on one segment or one segment of the client? So we always been focused on the cash market, which promotes investment behavior. You offer right research, right education, and then you also offer derivative who wants to trade online. And over a period of time, what has happened is that a lot of product innovation has happened. I am sure you would have come across a lot of talk about MTF, margin trading facility, which is a loan by brokers to client to buy a stock on the cash market. Now that has increased. The book is today 1,10,000 crore as we speak today. And there are some talks that is it big or is it something to worry about? But if you ask, compared to the developed market, we are nowhere there. It is just $12 billion of MTF book compared to 5 trillion market cap of Indian market. And that book or that product, it is helping us, create some leverage play in the cash market. See, derivative is a leverage play, everyone knows, right? You can have 400x leverage also on some of the expiry days options. And this product, MTF, where you buy stock with some leverage, where you put 1x and broker funds balance 3x or 4x, 5x leverage for a stock, and you create long-term investment behavior. I think this is what, as a full-service brokerage, we focused on. In fact, at Kotak, we are number 2 in the industry on MTF. We believe that this product is a controlled leverage play, and I think advanced investors can leverage this opportunity to stay invested in the market and make maximum income. And for brokerage also, this becomes an additional source of revenue, which is not only reliant on one segment of the market. So just to summarize, compared to the discount brokerage, as a full service brokerages, we have adopted 2-pronged strategy. One, we will have the better and best digital platform, which can match any discount brokers. And second, we will have products which are not only necessary catering to one segment, but we'll have a balanced approach on all the product offerings, and hence, thereby we will have a diversified revenue mix, which will basically weather any, cyclicality in the any one segment of the market.
But then most of this will be provided by the industry as a whole. So what differentiates, let's say, brokerage 1 from brokerage 2, and how does a client, or why should a client, why should a trader or an investor choose one brokerage over the other? What would be the USP? What would be the hook for a trader or an investor to opt for brokerage 1 instead of brokerage 2?
So, as we just discussed, that the entire gap between the participation and awareness in Indian market is that if 50% plus households are aware about capital market, they are still not invested into capital market, and there are only 2 reasons why they are not doing so. One, either they don't have confidence and trust where to invest, or second, they don't have a right information and right advice where to invest. If a platform is able to offer both, where to invest, and then there is a confidence in the platform. See, digital is going to be, you can say, boilerplate. That is hygiene. You have to offer best of the digital mobile app to all the clients. So that becomes necessity. That is no more a differentiator. The differentiator is going to be what kind of research and advice and education you are offering them, and what kind of trust you are able to create and comfort you are able to create them to invest into the market.
Where is the next leg of growth coming from brokerages? Is it tier 1, tier 2 cities, tier 3 cities? Pranav, if you could take that up.
Yeah, no, I think just to take Shripal's point further, and I think that's very, very true, is that as some of us who are bank-led platforms, our ability to access customers that's really deep into the country, right? You're looking at both urban, semi-urban, tier 2, tier 3, and you have physical presence both through the overall franchise in all of these places. So I think there is a sense, there's long-term, obviously, trust that's been built through time, and there's also a responsibility because you're not only selling broking products to them, you have a lifetime relationship with them. So it's super important. It's only one small figment of our relationship with that person, the broking business. So it cannot be that, you have a good market and therefore you push products, aggressively into them without really looking at long-term impact, right? So I think for a lot of us, long-term investment behavior and driving that, long-term is super critical to, both the success of our own franchise, but also to see the results. And I think to your question about, is it tier 2, is it tier 3? I think maybe the time has come to, look at this slightly differently. I think even in the urban pockets, there are, especially in the Gen Z onwards, there is a need to drive very strong education. And I think there's this perhaps sort of a misunderstanding that, a certain amount of education means that the investing behavior will be right? And I think the responsibility we all have, and I think well alluded to the panel earlier, is the advantages of compounding. How do you drive long-term investment behavior? How do you ensure it's at right leverage and it's not necessarily that you're driving too much leverage? And some products like of margin financing has huge advantages versus, say, taking unlimited amount of unsecured funding, right? So there are areas where they can display certain forms of loans that they deal with other forms. But I think my fundamental point is that we shouldn't believe that a tier 2, tier 3 audience are, they're not aware about the markets at all, and the urban pockets are significantly better educated. I think what we have learned through the last 3-4 years is that, just because you play in derivatives or you trade F&O, it does not necessarily mean that they understand it well enough, right? And I think so education, we have to really democratize. There is a real need in financial services to teach the basics of investing really well. And I think people have jumped loops too quickly, too fast, and it's really time for us to unlearn some of that and teach them, teach the journey, right? And patience. I mean, it really eventually boils down to how patient you are and how you can stick with it. And I think that's something which doesn't come naturally today. So we'll have to work harder to teach and imbibe that value.
Amisha, investors too on their part have become, if I can put it, smart investors using technology as an enabler. Is that something that the broking industry is dealing with right now? How to sift through too much of information overload and so as to enable clients to make the right decision?
Information overload definitely is there. But at the same time, the very same social media has enabled awareness. And if you will ask any 26 years old who has opened an account, I'm very sure he's very well aware of what he is doing and the risk that he is taking. He makes up his mind that so much capital I am ready to lose. It is not that he doesn't know he can lose. That much social media has created awareness. 2-3 other points. You were saying where the growth is coming. You know, the 50% plus of new accounts are getting opened from north and east of India, where typically the penetration was much lower. And south and west, which is the higher educated belt, the growth of new accounts is much lower. It's almost half.
What would you ascribe that to?
Under-penetration of this, and now that the population wants to catch up. Secondly, we say that retail investors do not understand. I once again do not subscribe to that. Why? Because they choose. If you see mutual fund inflows, they've also consistently by way of SIP grown and grown substantially. So they have made a choice for a long-term investments through mutual fund SIP, and this is again across India which has happened, the trend. And in that also, the average age is 28. So both goes that social media has actually helped a lot, both in awareness, education and penetration. But coming back, is there information overload? So one thing which is very critical in wealth creation, broking is one part, investments or trading is one part, but wealth creation happens not with information, with your own mind's discipline. And that is a complete learning journey which each of us have to do, and some of the best fund managers also have to do. So all these youngsters who start, I think what they will do, actual learning is going through this mental discipline, and which is a journey which everybody will have to go through.
So it's more about getting the attitude right rather than getting the timing right.
Exactly. Information is now going to be at your fingertip with the mobile, and of course it will continuously keep increasing, but get your attitude right is still the golden rule which will prevail.
I think if I can just add to that one point on north and east growth, I think one of the things that, for a lot of us to track closely is the ARPUs associated with some of those growth has not necessarily been the same as we've seen before. So there has been a lot of accounts being opened, but does that really translate into volume that's material is something, we'll have to see. You really need to see disposable income going up in these pockets, in my opinion, to start seeing that translate into, financial savings.
I was about to, this partly is my next question to you, Ajay, is that, given how the markets have played out in the last 12 months or so, is new money hard to come by in the broking / wealth management side? Or are you able to convince clients, because the things haven't been too great for the Indian markets in terms of tariffs, in terms of valuations, in terms of other things, now is the time to buy and buy for the long term?
So typically you're seeing that people, when the market is doing very well, you don't have to tell anybody. They all come on their own, and we have to tell them, wait. But this is the time when we have to teach them. So you have to look at it from different angle, that if you look at your SIP flows, it is still coming. It is coming in herds, right? That's a 27% CAGR growth year on year if you look at the SIP flow. So as you said, the investors are smart. They know that consistently putting money to the market will give them long-term growth in their overall investment journey. Coming to the derivative side, surely you have seen the impact that with the regulations, with the overall expiry going down, the people also understood that it is not, it is foolish to lose money like that. So they have also tried to rethink their strategy about how to put the money into the market. But fundamental people who are buying stocks, we have seen that good quality investments are coming in and people are ready to buy. And if you see the change in the dynamics, again, there is extreme to that. The maximum money is now coming into the IPO market, right? So when you're looking at money coming into the IPO market, so people are ready to invest. But now the question is that at what valuations are it coming? Is it the right IPO to buy in? Are the people making the right investment decisions? Again, it is a question about, are you taking the right advice? Correlated to it, the unlisted market. People now want to go into the unlisted market before they come into the IPO. Again, you have seen the darker side of it also. People have made good money investing into unlisted, but last few IPOs, people have seen that the unlisted market had valued it much more. So there is always a learning which people have to go through, and it has to be consistent. So the question is that, are you taking the right advice? Are you listening to the right kind of things? And when you are putting your money, if you are putting it from a longer term horizon, you are here to make money.
So you talked about the primary markets. Can the buoyancy in primary markets generate enough revenue for the brokers to at least partially offset the dent, if any, from the broking side revenues?
So from a broker's perspective, I think it is, from a longer term perspective, you have to look at it. More and more IPOs coming in, more and more promoters getting listed is good for the capital market, because if you think from a overall penetration of the Indian capital market, there's still a long, long way to go. So it is good from an overall capital market perspective that the IPOs coming in. The quality of the IPOs is something which we should look at, but then the market is intelligent enough. Once you get listed, the market shows its valuations to the right companies at the right time. So the money coming into the capital market, the IPOs coming, is really very good. That is how you democratize the overall economy in a longer term perspective. We are at the $4 trillion the economy now. It has to go to $10 trillion. It has to go to $15, $20 trillion in the years to come. It's just timing might be 2 years here or there. So what the first trillion took 50 years, the next trillion took 7 years and 7 years, and now it is going to take 2 years and 1 year for every trillion to grow. So money has to come in.
So in terms of regulation, Amisha, if I can ask you, what more is required? Or do you think that whatever we have is enough? At least let the broking side breathe. What is required? Is it a good question? I mean, anyone can answer that. We will start with you.
2.5 years. If you see the changes which were happening in the broking industry, even the vendors, the software vendors were not able to keep pace. And then that changes in regulations combined with compliance and audits was a real ISO 9000, ISO 15000, ISO 27000 that broking industry has gone through, I guess. But that really helps, because the broking industry is extremely healthy now. And a lot of risk as the market expands, we have to continuously reduce. The more you reduce systemic risk, better it is for long-term growth of the market. So I'm sure each of us have taken it in very positive spirit and adopted it. There are certain things on the horizons. And see, broking industry means two. Broking industry means retail, plus it also means institutional broking.
Correct.
And if you would have seen, just about a week back, a new paper has come.
Yes, SEBI consultation
from
paper.
SEBI consultation paper, where they are talking about institutional broking BIPs to be reduced lower than retail broking BIPs. And typically, institutional broking is supported by not only research and very in-depth research. It is corporate access. It is the expert access. which means that all these are support to your decision-making process when you want to put larger money in place, and the sales and sales trading for sourcing that. Now, all that combined at a time when the available number of stocks to research is substantially increasing with IPOs, if you constrain them to 2 bips, I think that's going to be too harsh, because most of us have both the sides into broking. And the level of service, the ability to reinvest in the business, all should be considered, I feel. So that part could be a little challenging, whichever way we see in next 2 years. Still, the volumes then once again catch up to help cope up with the reduction in income.
So over the next 3-5 years, given all this, can we expect some kind of a consolidation in the broking industry, Shripal? And if so, what players will be able to survive this? What's the moat?
So there are 2 parts. Consolidation is definitely going to happen, and it is the trend in all the industries. Now, why it can happen? One, it may happen because of the regulation, but I don't think regulation is going to drive the consolidation. I think consolidation will be driven by the demand from the regulator and customers in terms of technology investment, whether it is cyber security or resiliency or DR services. A broker is required to invest heavily into uptime and resiliency of the platforms. So one is the uptime and resiliency, and second is the product innovation. Lot more new players are entering into this market. And by the way, it is interesting to see this is the only world in the BFSI sector where most of the startups who enters into this space becomes profitable in 2-3 years. Now, it doesn't happen in all the industry, and that is why more and more players are coming into the. You can actually see a lot of monies flowing from VCs and private equity into this space. Every other month, you will have new players entering into this market. So on one hand, yes, the smaller and marginal players might get consolidated, but you will have no dearth of new players coming into this market. Over a period of time, number of law of 2 or 3 will survive. But I think we are far away. A lot of innovation is still pending. A lot of play on AI side is still available. It is still evolving. So I think it will get consolidated, but it will completely be evolving into a completely new game in next 3 to 5 years.
So on the wealth management side, Ajay, are you guys suggesting alternate investments such as investments in art, wines, etc., as secondary markets remain tepid and IPOs, as you said, a little, and the unlisted space also seems a little overstretched?
So we have always been suggesting to all our investors to be diversifying. So we always talk about not only broking, we talk about the overall wealth management, the distribution arm. So starting from the traditional MF, SIP, to the insurance, to alternate assets, we also always look at how the client's assets can be diversified, so that from a longer term perspective, it helps in the overall wealth journey. So I think it's natural that people should diversify into different asset classes depending upon their own risk and appetite of growth, right? So, but to your question about art and that, it is still too early days for India, I think, to go into those. It's very sophisticated market for the super HNIs. But from a retail perspective, I think you have to have some amount of investments into the mutual funds SIP, which gives you a sustained growth journey. And you should be looking at direct equity from a more about some part of your asset from getting alpha on the overall investment journey, and trying to understand stocks in a much more sophisticated manner, getting the research and then investing onto it. And the final thing should be derivatives, where you are ready to take much bigger risks and play the options market. But
So we have started the other way around.
The other way around. That
we
is the whole
started
point,
derivatives
that
first, and then we are
people have
graduating
come
to become a
from-
little more sophisticated.
Yeah, people have come from options
educated.
first and then gone to equity markets the hard way. So I think it's just a matter of time. People will come in the right way, and from a mutual fund perspective, that is the right way to look at it. Right, that is where the entry gate should be for the retail investors to start off, and then build on to their investment journey from a longer term perspective.
So in a sense, can we say that the broking industry will likely take a pause, assess the strategy, and then move ahead as it tackles smart investors amid AI boom and a host of newer asset classes?
Yeah. I mean, I think it really has taken some bit of a pause. But, when you look at the journey, I think we have had a secular run for a very, very long time, except for the minor COVID blip. So I think the whole markets have done really well in India. So has the retail story, and so has the retail brokerage story, right? So some of it, I think, happened because a bunch of regulations came together, like it just got bunched up. And so, I mean, all of them, I think, were required. And whether it could have been paced out better, the answer, in my view, is yes. But the fact that it happened and now we lived with it and we're through it, it essentially means that now we're sort of like, climbing back up, right? And it's climbing back up steadily, nicely, and shaping up well. And obviously, I think Shripal made that point that the penetration will go up. It's still low, and there's still, a lot of work to be done there. I think the cash market will become really the de facto go-to place for investing, and and we will all drive education into that space significantly more through time. And I think what technology and AI gives us is the ability to scale that, very quickly, very fast, right? What one person could do research on, you could probably do on 20 or 30 companies at the same time. And as that, the technology curve matures and your LLMs are better trained, your confidence levels goes up, I think we'll be able to do so much more with the current resources. So I see a lot of operational efficiencies that will come in the broking business in the coming years, which I think will really help us, even as, we continue to see pricing pressures and margin impact, etc. But the real story is the denominator growing and our ability to become more efficient as franchises.
Thank you, Pranav, for this. And now let me open up the discussion to questions. We'll take questions from the floor, if there are any. Please. You can identify yourself and a sharp question, please. We just have time for 2 or 3 questions.
I want to play devil's advocate. If you look at the American equities market, right, it's outperformed over both in long as well as short terms. So are Indian investors investing in the wrong market?
It really depends on, sorry, I want Ajay to take that, but I think it really depends on what is that, when you said it's outperformed over long term, what is the long term that you have taken? And when you say short term, what's the short term you have taken, right? So I personally don't think, it's true that the US markets have had a great run recently, but I think on a secular basis, if you take India's capital market growth story, we have done, if not better, we have done as well. And India has grown across the curve. A lot of the US growth has come in very, very small pockets, right? You can really identify the 20 companies that has led to that kind of growth. And whether that is sustainable, has it come, is earnings really backing that kind of growth, etc., are very deep questions for all of us to ask as well. So yeah, I think India continues to be a phenomenal place to invest. And for most of these investors, I think, we've seen some bit of valuation correcting through time, which is not a bad thing, but we still continue to see very, very good pockets of, investment opportunities through sectors.
In fact, if I can add another question to what the gentleman said. Is it time?
That 65% of rise in US and Chinese markets have come because of AI-related stocks doing well. If you take that out, those markets have not done better than India. So the whole of the markets have reeled under the uncertainty of tariff and the geopolitical. It's not that India only has suffered because of this uncertainty. And the second important point is, if you want to compare India, why should we compare only one market to the other? The better is, without doing anything, one standard product, gold you take, you were better off. Why should you go and take which stock, which company, which promoter? But you don't decide like that, right? There is a productive value of asset class as compared to the other. So there are phases, and that's how the multi-asset approach
to investing
is yes, that's the most important approach, rather than, you know, as what he said, wine and whatever art is the absolute ultra HNI or family office can afford. But all retail and all HNI should look at multi-asset approach. That is very important.
But do you think it is time for actually the regulators to look at increasing the amount that one can invest markets abroad? It has been static since quite some time.
But that is not the problem. Problem, I guess, is TDS. The moment you want to give anything abroad, you have to first cut the 10%, if I'm not mistaken, TDS. And that's what is deterring. And that is, I think, designed that a lot of outflows do not happen at a time when we need
money back home.
Yeah, at the right time, I think this will be looked at.
So do we have any more questions? Yep.
Hello, myself Cable. I'm working in Morning Star. I just wanted to ask, since last 4 years, rapidly brokerage companies have been grown up. Since rapidly, for the last 4 years, rapidly brokering firms have grown up. Flash brokering apps have came out. But since when you compare the leverage, they are giving 0 to 10% leverage, and compared to you guys are giving more than 50% leverage on MTF and daily deliveries. So we guys lost the amplifier, and how you manage the leverage with the increased risk and everything?
Could you just clarify? We couldn't understand exactly what
Did you talk about leverage?
Yes.
So you're saying that US leverage is much more?
No. Actually, compared to fast brokering apps, you guys are giving more leverage and MTF than compared to fast broking apps and everything, online apps and everything.
Okay, I think your question is that some of our brokerages give more leverage on MTF than the discount brokers. Is that correct question?
Yes.
So I'll answer that. First of all, let me tell you that MTF as product has always been offered by full service brokerages since long. I would say more than 5 to 7 years now. And some of these new players have started exploring this product just recently. And some of them have just gone live in last 6 months to 9 months. So they are still experimenting with the product. Whereas we are matured, we have got elaborate risk management system in place in terms of monitoring what is the liquidity of a particular stock, what is the volatility of a particular stock, what is the average daily volume of the particular stock. And based on that, there are stock level limits which are imposed, and based on that, leverage is decided. And by the way, leverage is also defined by the regulator. You cannot give more leverage than what regulator has given. So obviously, whatever leverage is offered is within the regulation. But yes, some of the new firms who have recently entered might want to test the water with a smaller leverage.
Any more questions? So it's a wrap then. Thank you, everyone, for sparing the time to come over for a very interactive and insightful session.
Thank you, Puneet. May I please request for the mementos to be presented to our panelists? I'm sure there were so many takeaways for everyone from this session and for broking industry overall. Yes, there are many challenges, but it is not going to pause. It is going to pivot, and that it is in a healthy shape. And couple this with all that you've heard today, starting in the morning with our regulator from SEBI to the recent fireside chat. I think we've all been enriched by the stellar panel of speakers that we had here for you and their views. Ladies and gentlemen, while this is the last panel discussion here, we have one final session of the day, that's the fireside chat, which will commence at the hall number 2 upstairs, hall number 3 upstairs. The fireside chat with former whole-time member of SEBI, Mr. Anant Narayan ji, Thank you for being such a wonderful audience. May I please have one round of applause? I know everybody is interacting with everybody. But this is where I say goodbye to you, and we will meet hopefully again in BFSI 2026. Thank you very much. Please do attend the fireside chat.